Okay, so today I'm going to share with you a very important trading lesson, right? This lesson is so important that it could save you four figures, five, six, seven, or even more in your trading career. And to teach you this trading lesson, I'm going to talk about chicken. Why chicken, right? Let me explain, right? I'm going to do it by talking about something called the Chicken Happiness Index. I don't think there is such an index out there. I just pretty much came up on in my head, and it will look something like this. Okay, so this is the CHI, the Chicken Happiness Index. Maximum, give it 100 points. This is the number of days that a chicken lives. To be honest, I don't know what's their average lifespan, but let's put it at 500. Okay, so when a chicken is born, come into this world, right? It's at 0, and then it comes into this world. Papa, mama love the chicken, right? It's being well fed, taken care of, and the Chicken Happiness Index naturally will rise. Then as the chicken, grow up and play, it gets bullied, right? And maybe take a slight dip in the Chicken Happiness Index, but hey, life goes on, right? And the chicken, continue moving ahead in life. Then who knows, right? Maybe enters puberty, right? The chicken got dumped by one of its female chicken, right? Maybe it's a little sad. Chicken Happiness Index takes a dive, and then hey, you know what? There are so many female chickens out there, right? Make friends, hang out with new ones, and then the Chicken Happiness Index take an increase, right? And then maybe towards the end, right, it starts maturing, right? It starts bullying all the little chicken. Wow, this is such a happy times in my life. And then what happened? Boom, right? What happened over here? Right? Why did the Chicken Happiness Index is at all-time highs, and then suddenly it take a dive back to 0? Well, if you think about this, right, what is the purpose of a chicken? The purpose of a chicken is that it's meant to be eaten, right? This is why the farmers they grow chicken, because they are eventually going to be slaughtered and eaten. That is pretty much the sole purpose of a chicken. I'm just being honest down here. So why am I sharing this story with you, this story of a chicken? Right? Because here's the thing, right? Imagine that you are a chicken right now, and you look through as your past 500 days of your life, right? You think that, wow, man, things are so good, right? It rocks to be a chicken, man. I love being a chicken. And never would you think that this day would come where you get slaughtered and everything goes to 0. Right? I mean, you as a human, you watching this video right now, you might laugh and think, how so-called silly the chicken is. But if you put yourself in the chicken shoes, if you look back at your last 400-500 days of living and things are so good, you would never expect that things could be so disastrous. Okay? And the reason why I share this with you is because if you look at this chart, isn't this similar to what you've seen earlier? The only difference that this is a financial chart. Okay, this is in fact, right, the XIV is the inverse volatility, right? This chart shows you the inverse of the volatility. So as you can see, price, right, clearly in 2017, right, they're making very nice highs, right, higher highs and higher lows, and then one fine day, bam, it's all gone. It's all gone. Okay? So, for those of you who do not know what's the inverse volatility, basically it's a way for you to make money going short volatility. So what happens is that, as you know, right, volatility in recent years has been taking a dive, right? It's been pretty low, right? Very low. So this product is basically the inverse of volatility. So when things, getting lower and lower, this product gets higher and higher. It's the inverse. And then as you know, recently, right, the stock markets, we have a massive spike volatility over the last few days. And then what happened is that volatility spiked up. So this chart is the inverse. What happened is that this thing collapsed all the way down lower. It's just the inverse. So this is the inverse volatility. And the reason why I share this with you, the chicken story, is because if you look back at this chart historically, this has never happened. So as a trader, as an investor, what would you think? You would think, man, life is so good, man. This product is so good to trade, right? Money is rolling in, right? What could go wrong? Well, this could go wrong, and this can be very, very wrong. And it has, hurt many traders and investors alike. So here's an example of a trader who lost $4 million and 3 years of hard work overnight by trading the XIV. So I have nothing against this trader. In fact, I do respect him because at the end of this saga, he mentioned that he's 100% responsible for whatever happened. And I thought that was a hallmark of a good trader because, you have to take 100% responsibility of what happened to you, right? So this is something that I would say, that deserve my respect. But at the same time, right, here's a lesson that we all can learn on how he actually lost $4 million. So from what I've read, he started with a 5-figure trading account, and then he was long the XIV. He was long the XIV product, right, the inverse volatility. So the market went in his favor, nice uptrend, very strong uptrend, and then finally over here it collapsed. So when it collapsed at this point, right, he was actually leveraged extensively, because as the market moves in your favor, you thought you can make more money and you leverage extensively, and then finally the so-called bubble pop, and then he lost everything as the market collapsed. Okay, so that was how it happened. And if you're wondering, right, this does not happen to just a retail traders, and in fact this has happened a few times already in history, right? Human emotions never change, greed and fear. And if you look back about, say, in the 1990s, right, similar thing happened to LTCM. What is LTCM? LTCM stands for Long-Term Capital Management. It's a hedge fund in the 1990s founded by Merriweather, Merton, and Scholes, right? A very popular names in finance. Some of them are Nobel Prize winners. Some of them used to work for Solomon Brothers. So this is a very prominent hedge funds in the 1990s, and their strategy was basically trading spreads. They were betting that spreads would converge back, right? The yields will converge back. So what happened is that for the first few years, right, of their trading, right, in fact, the market did what they expected it to do, right? The spreads converge over time. But what happened is that over here is that Russia default on their debt and the spreads tear, and that's where they pretty much lost big time at this point. So again, right, it's like the chicken story, right? You look back over the last X number of days or years, things are doing good, right? What could possibly happen in the future? Well, this can happen. Right, similar for the XIV, right? The trend has been beautiful over the last few years. What could happen? Well, the market can just spike up, volatility can pick up, and hey, the product collapse. So what is the lessons for you as a trader? Number one, risk management. I know, Rayner, risk management, blah, blah, but okay, this is a fact, right? If you think about this, why do you think, all those financial products or, trading education sites, they put there, past performance is no guaranteed of future performance, because precisely of what I've just shared with you, right? It's very easy to get caught up in the notion that something that has worked X number of days for the past 2-3 years, and you expect it to work again in future. No. Okay, in fact, the time that you are doing well is the time that you need your risk management, because this is when the market usually would do something, would surprise you. Okay, so risk management, always, right? Think about your downside. Anything can happen in the markets. Number two, know your product. So I believe some of you might be thinking, right? Hey, Rayner, if I were to trade the XIV, right? What I'll do is I'll have my stop loss over here. So if the market takes a dip, I'll exit the trade. I am protected. But here's the thing, right? A product like XIV may not give you the liquidity that you want when you want it. Because at this point, maybe, a whole jing gang of traders are looking to exit at this price. And if everyone is looking to exit at a similar price, that means that there is no one left to buy. So what happens is that the price will take a dive lower and lower and lower until a point where buyers think it is low enough, and then they come in to buy. So you may actually end up exiting your trade, right, near the lows of the uptrend. Okay, so number two, know your product, right? Know the liquidity that it offers. This is important, right? If you trade an illiquid product, any massive spike, slippage, right, could cause you to lose more than you intended. Number three, if it's too good to be true, it probably is, right? So this actually is aiming towards traders who sell options. I'm not saying that is a poor strategy. That is a viable strategy. However, you want to be aware that certain black swan events could happen, right? For example, a lot of times traders who sell options, they are making money very consistently, month after month, month after month. But then it just takes one, spike in volatility or something like that, right? Where you can lose all your profits that you have accumulated over time. So if it's too good to be true, it probably is, right? So this can also be applied to, trading systems with 99% win rate. Again, be aware of it. Or, financial products that someone is selling you, like you make a guaranteed 24% a year. Again, if it's too good to be true, it probably is, right? And the final lesson that I have for you is this. Love your chicken, right? I mean, look how beautiful a chicken is. It feeds you and even teach you a financial lesson, right? So love your chicken. Okay? So now, for those of you who want to learn more about what I do, or maybe you're wondering, who the heck is this Rayner guy, right? You can just go down to my website, tradingwithrayner.com over here. I offer a couple of trading guides that would help you in your trading journey. One is called the Ultimate Trend Following Guide to help you ride big trends in the market, in bull and bear markets, and the other one is the Ultimate Guide to Price Action Trading. It's for helping you better time your entries and exits and to read what the market price action is telling you. All right, so these two guides are free. Just click on this blue button and I'll send it to your email. Okay, so with that said, I have come to the end of this video. If you've enjoyed it, please hit the like button, subscribe to this channel, right? And I'll update you whenever I post a new video, so you don't miss any of the stuff that I publish. And last but not least, if you have any questions, leave it in the comment section below and I'll get back to you. So with that said, right, I'll talk to you soon.